Real-world assets, or RWAs, have become one of the hottest topics in digital assets. At its core, tokenization means taking a claim on a real-world tangible or intangible asset and representing it on blockchain rails. Real-world assets can be almost anything in this context: treasuries, real estate, oil, oranges, trees, what have you. You can even have RWAs of other RWAs, but let's not get ahead of ourselves. For years, tokenizing real-world assets was just a theoretical discussion. Since then, a very few successful use cases have emerged, the most visible of which is BUIDL, BlackRock's foray into tokenized treasuries. Launched in March 2024, BUIDL is BlackRock's first tokenized fund on a public blockchain designed to offer institutional investors exposure to US dollar yields through tokenized shares. The fund aims to maintain a stable value of $1 per token and invests primarily in cash, US Treasury bills, and repurchase agreements. Investors receive daily dividend payouts directly to their wallets, with the fund's assets fully allocated to so-called high-quality liquid assets. Initially targeting investors with $5 million or more to invest, the fund has expanded into share classes on 7 blockchains: Ethereum, Arbitrum, Avalanche, Optimism, Polygon, Aptos, Solana, and the BNB chain. The BUIDL ecosystem includes Securitize, a tokenization platform, Coinbase for infrastructure, Anchorage Digital Bank and Fireblocks for custody, and BNY Mellon as the administrator. BUIDL is a leading RWA use case today because it addresses a real institutional need. Treasuries are already the foundation of global collateral markets. BlackRock's tokenizing treasury exposure doesn't change the underlying asset, but rather the rails on which they're traded. BlackRock's success here is not based on making treasuries more exciting, which would be a bit of a tall order. It comes rather from making high-quality collateral easier to use, and this is the key to the attractiveness of RWAs. RWA tokens offer 24/7 access and liquidity. No bank holidays, no guessing over the weekend where the markets will open on Monday. RWAs bring the always-on genius of cryptocurrency to things that already exist. That said, BUIDL is not for everyone. It's a regulated investment product for qualified investors, and when I say regulated, I mean that the legal structure, custody framework, investor eligibility, and off-chain administration still matter. Blockchain improves the wrapper and the transfer mechanism. It does not eliminate the financial architecture behind the product. This is important with respect to how we apply the BUIDL example to your RWA project. Put another way, you will need to connect the world your asset lives in to the crypto world. BlackRock put the whole chain together. They took the stodgy treasury bond and created a token that pumps out the yield that bond generates to the investors. They made sure to lay the legal and practical scaffolding that was required to make sure that there were no hiccups in the process, enforceability issues, or other matters. And BlackRock certainly has the means to do that. You must do the same. Let's take real estate as an example. Say you have an apartment building that you want to tokenize. In theory, investors from all over the world can buy the equivalent of one of the bedrooms and benefit from the project in proportion to their investment. Your RWA token could be traded 24/7 on Ethereum or Avalanche or what have you, and transferred almost instantly between owners. It's a great idea, and we will get there, but just remember that the scaffolding matters. Imagine in this scenario that due to a recession, the building goes into default and the bank wants to foreclose. How would the bank get all the interests in the building, which are now represented by tokens, back into its wallets? Does the bank even have wallets? What rights and obligations would token holders have in this scenario? Are the tokens redeemable for other types of property interests? Whose names are in the documents at the county recorder's office, and so forth? You see where I'm going with this? RWA tokens add liquidity and flexibility and allow distributed fractional ownership, all good things in my opinion. At the same time, the world the asset lives in doesn't just go away. There must be an unbroken chain between your token and the asset it's supposed to represent. Otherwise, it ends up as just another air token, as Michael Saylor likes to put it. Sounds good, but not really based on anything. So where are you in your RWA project? Write me if you'd like to discuss your project more. We can examine the scaffolding together, that is, what world does your asset live in, and what are you looking to achieve with your token? I'd be delighted to help. I'm Ari Good, blockchain lawyer. Thanks for watching.